What does LASER stand for? In this episode, I'm going to address that most places where people invest fail the LASER test. I'll explain what that is and how you can choose the right vehicles for your long-term goals to put your serious cash into, money that you do not want to jeopardize or lose. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for north of 48 years, helping people optimize assets, minimize taxes, and empower what I call their authentic wealth. And I've been very blessed in my life to have authored thus far 12 books. I'm working on my 13th. But my 11th book is titled The Laser Fund because of this acronym that I came up with years ago, LASER, laser focus. And laser, as an acronym, stands for liquid assets, safely earning returns. And so let's talk about how I came up with this order of key elements of a prudent investment, because any prudent investment where we want to put money to keep it safe and accumulate at a nice rate of return for a future goal and hopefully have some tax advantages associated with that, there are key elements. And I noticed early in my financial planning career that most financial advisors, I thought, were out of order, out of whack in what they placed as the number one priority. It seemed like most advisors, and hence their clients, were greedy and always put, I've got to get a rate of return first. And you probably know that if you go after high rates of return, you're going to incur higher risks. And there's a lot of people that, of course, are risk adverse. They don't want to risk losing their money, but you want the highest rate of return you can get with the lowest amount of risk. But those two work against each other. And so I found that most serious tragedies or times when people lost their homes in foreclosure, like in 2008, and times where maybe they had setbacks, is when they lacked liquidity. Okay, liquidity is the ability to access your money when you need it, without incurring penalties or taxes or having to wait to sell a piece of real estate to get your money out of there because it was tied up. And so I noticed that liquidity was really the number one reason why most people lost tons of money and had to start over again. The second big reason that people lost money is they didn't protect their principal, and they didn't choose safe institutions or safe vehicles to put their money into. And so liquidity ended up being number one, and number two was safety. Number three was rate of return. And yet so many advisors put those in reverse order. So I began to teach this years ago as the key elements of a prudent investment: liquidity, safety, rate of return, and then any tax benefits are nice, but they're sort of like icing on the cake, so to speak. And so in this particular episode, I'm going to talk about why I wrote the book, The Laser Fund, and my favorite vehicle. I call it that because it passes what I call the laser test with flying colors compared to where most Americans put their serious cash. This is money earmarked for future long-term goals like retirement or college funding for their kids and grandkids, or working capital for business or real estate management or emergency funds or what have you. And so my 11th book has been flying off of our warehouse shelves, and it's titled The Laser Fund: How to Diversify and Create the Foundation for a Tax-Free Retirement. Now, stay with me to the end of this episode because I'm going to gift you a free copy of this 300-page book. You don't have to shell out $20 on Amazon. I'll gift you a copy. I'll show you how to get that. And as I proceed here, be sure and click like or post a comment, but most importantly, subscribe. It's free. And when you do, click that little bell so you'll be notified every time I post a new educational video. I have over 800 on this channel, and I post a new one almost on a daily basis, okay? So you'll notice here on the front of the book, I'll just use this as an example, LSRT, okay? L stands for liquidity, S is safety, R is return or rate of return, and T are tax advantages, okay? You'll notice these are bars. That's because in the book, I talk about in chapter 4, the laser test, because you can take any investment. You could put money into real estate. You could put it into municipal bonds, mutual funds, annuities, all kinds of different investments, stocks and bonds and what have you. But based upon the risk associated with it, you can begin to assign a score on a scale of 1 to 10 based upon these 4 pillars. So that's why they are pillars. And this is a bar based upon 0, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 in that particular chapter. And so, for example, liquidity is the ability to access your money when you need it. With an electronic funds transfer or phone call, a lot of times people get confused and think liquidity would be like money in a bank because a bank or credit union has a drive-up window. No, in actuality, if things get really bad in this country, banks and credit unions can say, sorry, you cannot get your money out of here for 6 months if there's a run on the bank. Did you know that? You need to ask yourself, where do banks and credit unions put their tier 1 assets? Now, a tier 1 asset is money that they have to have on hand, liquid and safe, accessible in case of a run on their bank. And they'll turn around and put 30 to 40% of their tier 1 assets, for example, into insurance companies because that's a multi-trillion-dollar industry and they have reserve requirements that are far more stringent than banks and credit unions. That's what happened in 2008. When about 400 banks went under and 900 more were on the brink of going under, what is called the watch list, the federal government asked the 5 major banks in America to disclose where they have their tier 1 assets for liquidity and safety. And it was in insurance companies, a lot of times in BOLI, B-O-L-I, bank-owned life insurance. And what they were doing is they were borrowing OPM, other people's money, and paying a measly 1% or less. And they turned around and increased the safety, okay? And it was totally liquid by usually 5, 6 notches higher. And they actually got about 5 times the return. And they were getting 5%. They didn't even link to an index like I suggest in this book. So every million that we loan a bank by depositing it to them, they turn around, they pay $10,000 a year in interest. They turn around and make $50,000. $50,000 is 500% or 5 times what they pay us, which is only $10,000. And so I often ask, would you hire an employee for $10,000 that made you an extra $50,000? Yeah. Would you buy a widget machine for $10,000 that made you an extra $50,000? Yeah, I'll do that all day long. That's called a 500% return on employment cost or equipment cost. And so you want to choose the vehicles that you can get your money when you need it, even with an electronic funds transfer or phone call in this day and age, not just an institution that has a drive-up window. Does that make sense? So liquidity, you'll find out when you study this book that a max-funded indexed insurance contract, structured correctly and funded properly, passes the liquidity test with flying colors. Safety. Not only you get safety of the institution because the multi-trillion-dollar insurance industry is probably the last domino that would fall if we had a total collapse of the monetary system in America. I want to have my money and the last domino that would fall because if that collapsed, it wouldn't matter if I had my money, okay? The American dollar would be worthless. You better be able to grow carrots in your backyard. So liquidity is number 1, safety number 2. That's why I love the Laser Fund because it scores way up here on a scale of 1 to 10, 8, 9, 10 out of 10 possible points. Most places, IRAs, 401ks, if you tap into it, you have to pay a 10% penalty. If you're under the age of 59 and a half, you have to pay tax. Some companies won't let you tap into it. Money trapped inside of a piece of real estate, an equity, or a home, you have to sell it. Or you have to try to borrow on it. And sometimes when you need it the worst, it's the hardest to get. You can't qualify. So there's a lot of investments that do not pass the liquidity and safety test much more than 2 or 3 out of a possible 10. When we talk about rate of return, you don't need pie in the sky rates of return if you have tax favored rates of return and not just tax deferred. Tax deferred is okay, but tax free is far better. And so you'll find out that there's only a few vehicles in the Internal Revenue Code that allow you to accumulate your money totally tax free. And the LASERFUND does that under Section 72E. You can access that money, including all the gain, totally tax free under Section 7702. And when you ultimately die, anything left in there blossoms, increases in value. If I died right now, every million I might have in a portfolio of laser funds would blossom to about 2 million and transfer tax-free. That is very advantageous because it's tax-free. Nothing else does that in the Internal Revenue Code, not even municipal bonds or Roths, okay? The rate of return, I've averaged, 9.62% over 20-year periods. Some periods you may not earn anything, but you don't lose because of indexing. Other times you might make as much as 25% or 61%, like some of our clients did using the LASERFUND in the year 2020 to 2021 because of the COVID-19 pandemic. But if you earned a 10% tax-free return, that would be like earning 15, 16% in a tax-deferred IRA or 401k, pulling out the money and having to pay tax of a third between federal and state tax to net 10. I only have to earn 10 to net 10. Does that make sense? In a max-funded laser fund, if it's structured correctly. Now, I'm actually earning maybe 1% higher than that. I'm earning 11 and netting 10, or earning 7 and netting 6, or earning 25 and netting 24. But these are the 4 pillars. So the laser test is liquidity, number 1. 2 is safety. Number 3 is rate of return. And the 4th is tax benefits. When you take any other financial vehicle, all the popular ones out there, the best scores are usually only about 18, 20, 22 out of a possible 1, 2, 3, 4, 40 points. The LASERFUND is called that because it's the only one that scores like 33, 35. It may only score 33 during the first 5 years, but after 5 years, which is really the definition of a long-term goal, it scores 35 or higher. That's why it's my favorite vehicle. That's why I would recommend that 40 to 60%, maybe more of your retirement income pass the laser test. And so this is for serious cash. Does that make sense? Here's how you can claim your free copy to learn more about this if this is intriguing you. I will gift you a copy of this. Here's how you claim your free copy. You simply go to laserfund.com, laserfund.com, click on the link below. You contribute a nominal amount towards the shipping and handling. I cover the rest of that, and I will pay for the book. I'll send that out to you. There's also options there if you like to listen and learn, watch and learn. We even have online educational events. I have a lot of other educational videos on this channel. There's options there to join us for a webinar or even a live event in your area. But there's also an opportunity to pick the brains of some of the top financial advisors that I've trained in this country that can help you understand how to apply these concepts in your particular set of circumstances. So engage. This is about you and your brighter future, and I want your money to pass the laser test.